Welcome to this lesson on discounted cash flow, or DCF. This is a fundamental valuation method used in corporate finance to determine what a business is worth today based on the money it will generate in the future. By the end of this video, you'll understand how to value investments using their expected future earnings. DCF is a valuation method that estimates the value of an investment using its expected future cash flows. In simple terms, it helps us determine what an investment is worth today based on how much money it will generate in the future. This is crucial for investors, business owners, and financial analysts who need to make informed decisions about buying companies, evaluating projects, or assessing investment opportunities. The foundation of DCF analysis is the time value of money. This principle states that $1 today is worth more than $1 tomorrow. Why? Because money available today can be invested to earn returns, creating additional value over time. This is why we can't simply add up future cash flows without adjusting them. We need to discount those future amounts to reflect their true value in today's terms. Every DCF analysis relies on three key components. First, free cash flow, which is the cash generated by the business that's available to investors after all expenses and capital expenditures. Second, the discount rate, which is the rate used to convert future cash flows to present value. And third, terminal value, which represents the value of the business beyond the forecast period. These three elements work together to give us a complete picture of a company's worth. Here's the DCF formula. It shows that the present value equals the sum of all future cash flows, each divided by 1 plus the discount rate raised to the power of the year number. In practice, this means we take each year's cash flow, discount it back to the present, and then add them all together. The result is the present value of the business or investment. Let's dive deeper into free cash flow, or FCF. This is the cash generated by business operations that's available to all investors after capital expenditures. The basic calculation starts with EBIT, or earnings before interest and taxes, multiplies it by 1 minus the tax rate, then adds back depreciation and amortization, and subtracts capital expenditures and changes in net working capital. This gives us the actual cash that the business generates for its investors. The discount rate is the rate used to convert future cash flows to present value. It reflects both the risk of the investment and the opportunity cost of capital. In most DCF analyses, we use WACC, or weighted average cost of capital, as the discount rate. WACC represents the average rate a company must pay to finance its assets, weighted by the proportion of debt and equity in its capital structure. Terminal value represents the estimated value of a business beyond the explicit forecast period. This is important because we can't forecast cash flows forever with precision. Often, terminal value represents the majority of the total company value. One common method to calculate it is the Gordon growth model, which takes the final year's free cash flow, multiplies it by 1 plus the growth rate, and divides by the difference between WACC and the growth rate. The DCF process follows 4 main steps. Step 1. Project future free cash flows for the forecast period, typically 5 to 10 years. Step 2. Calculate the discount rate, usually WACC. Step 3. Calculate the terminal value for all years beyond the forecast period. And Step 4. Discount all cash flows, including terminal value, back to present value and sum them up. This gives us the total enterprise value of the business. To wrap up, DCF has several key strengths. It's based on intrinsic value rather than market sentiment, it properly considers the time value of money, and it provides a comprehensive analysis of a company's worth. However, it also has limitations. The results are highly sensitive to assumptions about growth rates and discount rates. It's difficult to forecast cash flows accurately, especially many years into the future, and it requires accurate financial inputs and assumptions. Despite these challenges, DCF remains one of the most widely used and respected valuation methods in corporate finance.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.